feel like you can guess at that, right?
Opposite of influence.
All right. Enough with all that.
All right, how about this? Well, enough of that. Belski,
Yeah.
2022,
Yep.
tough year.
Yep.
Tough year for the Belskinator and all of us, let's be honest.
Totally.
So I had Sean, this guy,
That guy.
go back and listen to our episode from the last time you were here.
September?
Just to sort of February.
February. Okay.
You sounded so young and innocent then.
And dude, you nailed it.
You
2023 is a comeback year for you.
Oh my gosh.
Let me set the stage.
Thank you.
So at the time, you said the bear case was 3,600, the base was 4,300, the bull case was 4,800. We're at 4,550 today, which, oh, by the way, happened to be your year-end price target. In your 20 years, 30 years on the street, have you ever gotten the year-end right?
Every year.
No, for real, it's impossible. You're throwing darts, but you did it this year.
You just say plus 8%. It's
So
not throwing
this
darts.
is dangerous.
Whatever it
No,
ends
the year's
year,
not over. The year's not
you
over.
just say 8%.
The year's not over, but if it ended today.
2022 was humbling, and we had a great opportunity to apologize to a lot of clients that we lost the money. It just sucks.
You didn't lose the money, the market did.
Well, we did because those are the choices that we made. Okay,
Sure.
And we have that responsibility. And you know, I've lost my job 3 times in this gig. This is my 34th year. May 3rd of 1990 is the first day in the biz that I got paid to do this job. I was doing side projects for people, but in 2004, well, I'm laughing. It's 2004 from the USA Today. I won the award for the stock picker of the year, meaning the strategist was the closest to the market. And I got fired in 2005. So I don't need that right now in my life. But no, I mean, I think I made this.
Is that like the Madden curse?
Yeah.
It
Like
is.
you're on the cover of the box.
Or the Sports Illustrated curse.
Right.
But listen, we said this before. Stocks are up 7 out of 10 years. Bulls make you money. Bears are smart. I'd rather make people money. And we've got, we have a process, or we say in Canada, a process, to and how we do markets. And I got one guy that's worked for me for 17 years, God bless him. And he took my models that I had before we started working together at Merrill in 2006 and supercharged them. And we've had a remarkable consistency in terms of how we've called markets, and in terms of being as tight as we are going to be this year again. And so we're very blessed and fortunate. I remember I was at the only time I've ever gotten a call from a CEO, aside from Stan O'Neill not wanting to talk to me because I was bearish financials in 2008, is Bill Down, who was the former CEO of BMO. My very first year at BMO, 2012, and I nailed the target. My very first year and I nailed the target. I'm flying to Cancun with my family. He calls me on my personal cell phone and congratulated me.
And everyone was bearish in 2012.
Oh, of course they were.
Everyone.
Double dip.
It was the obvious thing to be.
Mm-hmm.
Right. Mm-hmm. Okay.
Now, sentiment plays a big part in it. But remember last time you asked me, the very first time I was on the show, you said, what's the best financial book they ever read? And I said, The Art of Contrary Thinking by Humphrey B. Neal. And you don't want to be different than everybody else just to be a dick or be cocky or say, hey, you guys are nuts. If you have the contrarian viewpoint that in the analysis that backs it up, be contrarian. And so and nobody reads my stuff, but on page 2,
we do.
in my prologue, it was kind of classic Belski because I went after the Bears a little bit. But I was respectful, and I call them the Yeah But Bears.
Love it.
And this is a really tough gig. But
yes, the market went up, but it's only because
the yeah but is the wall of worry.
But we're gonna have a recession this year. Right. Yeah, but inflation makes stocks go down.
Stocks. Right.
It's only 7 stocks, no participation. Markets can't go up. Blah blah blah. But I'm gonna be right this year. It's not. I was wrong. It's not. I was wrong, and I'm sorry that I was wrong.
Sometimes though, not most of the time.
Well, if you take a look at the Bears on Wall Street right now, and have they come out and said, I'm sorry, I got it wrong.
No, they do a mid-year. They do a mid-year up. Instead of saying you're sorry, you get to come out in June and look back at what you said in December and raise your target.
No, you said,
but they don't do that though.
What I said is still true. That's what they say. What I said is still true.
Exactly. It's just
the price changed, but what I said is still true.
The market's
wrong.
Yeah. Anytime you say the market's wrong in this business, look out, sister.
Yeah.
Run for the door.
You're all idiots. I'm right.
Yeah. Oh, yeah. And there was a lot of that going on. If you remember, Josh, back in 2008, oh my gosh.
Yeah.
The market's got it. Market's got it wrong. You guys, this is stupidity. And Guess what? The market was right.
Was the market wrong in 2022?
No, because and I got a lot
Market
of,
was right. It discounted an earnings recession early.
so
Right?
Wonderful
Good.
point. So I'm on the channel. We know what it is, and I said, and I'm only on Twitter, by the way, just to see what people say about me because I can't say anything because I'm a registered
Yeah,
analyst.
that's healthy.
Isn't that great?
What are they saying about you?
Well, so I said stocks lead earnings, which lead the economy. Stocks lead earnings, which lead the economy. We've seemed to forgot that
The order of things?
Yeah, that stocks are an efficient discounter of what's coming.
Yes.
They
Right?
did that last year and this year.
Yes. Thank you.
All right, 3 claps.
It's a golf
coming in.
clap.
He's back.
The Compound and Friends.
What show is this, John?
Episode 121.
Oh, shit. Give me my music. Make it louder. For decades, Dimensional has helped move the investment industry toward more transparent, data-driven solutions for investors. Their founders contributed to the invention of index funds, and the firm broke new ground in offering small-cap investing as a diversifier, pioneering factor investing.
More recently, they've had success with their ETFs. Since launching in 2020, they've been the fastest growing ETF issuer. They now offer 38 ETFs spanning global equity, global fixed income, and global real estate markets.
That's right, Michael. Dimensional builds portfolios that emphasize dimensions of the market that research shows have higher expected returns. Their low-cost, diversified investment solutions are in many ways similar to index funds, but go a step further in that they take a more systematic approach to pursuing higher expected returns. So they're not active in the traditional sense, but they're not quite passive either.
That's right, Josh. Their long-term track record shows the value their approach has delivered over indexing. Over the past 20 years, 70% of their funds have outperformed their respective prospectus benchmark, compared to just 16% of the industry. To learn more about the dimensional difference, visit dimensional.com.
Yo, shout out to all you Belski haters out there.
Yeah.
Keep saying that shit on Twitter. He loves it. It fuels him.
It fuels my hate fire.
He's Canadian, but he's not going to be nice about it today. You know what I'm saying? If you hate Belski this year, wait till 2024. More reasons for hate.
Nobody hates Belski.
No, just kidding. I don't really think you have that many haters. I mean, you used to, but now they all deliver for Amazon, right? So, all right. Listen, I read your stuff. I don't always agree with everything you say, but like honestly, you make people money. I mean, that's not every year, not every quarter, but you give people a framework, and more often than not, directionally, markets go higher, and you give people reason for why they should go higher. Here's one of the things you said to me last time you came on that I loved, and it stuck with me. You said, all right, enough already. I'm going to start rapping if you don't turn that shit down. I'm going to start telling you how my money don't jiggle. You said, guys, we're too hard on ourselves. We've been through a lot. You said this, right? You were explaining because I was like, well, this and that and this other thing could go wrong. And you just said, we deserve a break. Like the things should work out okay. Now, it so happens that was true. It didn't have to be true.
Yep.
It's still a profound point. We shouldn't always be looking for why things are about to go wrong. They will from time to time, but that shouldn't be like the quest. I feel in the social media age, investors are very often searching for the next thing that's going to go wrong. And it's almost like what they set out to do that day. Even if they're not shorting the market, even if they're long, they're still like, well, where's the danger? And it's natural, it's healthy to be skeptical of bull markets, but maybe that's overly so. What do you think?
Yes, I think the best way to put it is we're so afraid to be wrong, we don't want to be right. And I think it's a secular problem since the tech wreck that was accentuated during the credit crisis, which since the credit crisis, things have not been normal.
So, man, what, 06, 07?
Since the Fed opened the window of August of 2007, shit has not been real. Meaning you can't have 0 to 3% interest rates or 0 to 2% interest rates. You just can't. That's not sustainable. And it's going to take a while to unwind from that. Okay. And we have now reared an entire generation of investors that only think that stocks go up if interest rates go down. It's not true. In fact, in our report, we talk about how there's actually not a great correlation between interest rates and stock market performance. There isn't. So we may think that. We have become so macro dominated in our thinking. Remember, stocks lead earnings, which lead the economy. I heard some person that we sometimes sit next to on the channel, the 4-letter channel, that said, you know what, I'm gonna buy once I know there's a recession. Good luck with that.
Yeah.
You know?
Once they hand you the document
Yeah.
affirming that
Right.
we're in recession.
Right. It's kind of like, do you run your life like a spreadsheet? And some of you probably don't know in the audience what double underline or Lotus 1, 2, 3 and all that kind of shit happens in accounting. Then I'll buy something when it all adds up. That's not investing and that's not life.
No, you have to buy some degree of uncertainty. Sometimes it feels that there's more uncertainty than at other times, but there's always the same amount of uncertainty.
Right.
You really don't know.
So my very first mentor on Wall Street was William O'Neill. And he said, Brian, don't let anybody ever tell you that there's nothing going on in the market because there's always something going on. And we're always going to be complaining. And this was 1990. I mean, you go back to 1990, look what happened in the market there. There's always something going on. We're always complaining. So we just have to deal with it. Now, given the age of how you started this diatribe with respect to social media and no one doing the work and bullet point analysis and so afraid to be wrong and they don't want to be right. Fear sells, right? Fear is sexy. Fear is, the bears are seductive.
I click on fear.
Fear has Riz.
Fear has
Fear
major
has
riz.
riz.
Major
Fear
riz.
has total riz.
Hey, look, we just named the episode.
Brian,
Say we're done with that part.
The market is more likely to be up 20% in a given year than it is to be negative.
Yes.
More likely to be up 20% than down. And so the thing that we should be searching for that we never do because it's hard is what can go right?
AI.
AI.
Is that rhetorical?
What if
Weight loss.
what if this, riddle me this, Batman. What if the Fed cuts rates because inflation goes down faster? Not because the economy slows.
And that's what everyone thinks. Everyone thinks if we cut, it's because the economy's slowing.
Yep, we're gonna pump up unemployment. Economy's gonna slow. We're gonna have an earnings recession. Fed's gonna cut.
They're not cutting.
They're not gonna cut. No. What if we go through all next year and they don't cut? Holy shit! You get a steepening of the yield curve. Banks rip. You get participation across the board.
Well,
wait, you don't
I
think
ask you a
they're cutting?
question?
Yep.
So I think directionally the next thing is a cutting cycle. But why would you cut? Why would you cut now? For what purpose? You literally have everything in the palm of your hand if you're a central banker.
There's no reason to cut.
Okay. You have a job market that's great but moderating. You have like wage gains that are moderating. You have shelter costs that are moderating. It's fine.
Wait, why
Leave it
is there no
alone.
reason to cut?
For what purpose?
Because what if you say mission accomplished, they've done enough. They've
never say that.
They've been restrictive enough. Inflation is coming down. Wage gains are coming down. It's all heading in the right direction. There's no need to be this restrictive.
I think they cut if inflation really, really goes lower. Like we're talking 2% or lower. What? What if that happens? They're cut.
But for to what end? Because they think it's going to get worse. When inflation hits 2%, what else is happening in the economy
Well,
to
That means the
have
economy would have cooled significantly for
that? Like,
inflation.
are we at
to get down
5% unemployment rate at 2%, or are we still at 4%?
I think we're still at 4%, but the bond market's going to do most of the work for us.
there. It's doing it.
I know.
But if we're maximizing employment,
Mm-hmm.
which is tenet number one, and then tenet number two is stabilized prices, if we do both of those two things without a rate cut, what's the necessity to cut rates?
But Brian, let me just tee you up before this answer.
Please.
So you said this in February 23. It was true today. It is true today. You said we need to see a massive reversal in labor trends to trigger a recession. That's what you said with us in February. It hasn't happened. So, Mike, back to you.
Yeah, everyone's got jobs. And remember, too, the other thing I said, too, we have a massive amount of people that are underemployed. And they're still kind of coming back. And you know what's interesting about the wage stuff is that white collar, it was a tough year on Wall Street because we had a lot of RIFs, reduction in force. A lot of people lost their jobs. We're in a tough compensation cycle. It was comp day today at my employer.
Nobody feels bad for Wall Street.
Well, the city does.
Yeah.
Right. And I think the high end is coming down, the lower end is coming up. That from the marginal side, though, I mean, you really have to come up. But I don't see that reversing anytime soon in terms of just how steady wages are, how steady the economy is. We're still spending money like drunken sailors. We're just changing the way that we spend. We're still spending the money.
Ironically, in the JOLTS report that came out this week, one of the new trends is, for the first time in a long time, leisure and hospitality hiring has now gone negative. So this was the most bulletproof part of the economy, was people traveling. That's now not in any major way. I think it's like minus 7,000 jobs or something.
Yeah.
But just still, it's not up
It's
200,000.
because if you try to book something in December for the prices are astronomical. I'm guessing that within the next week or 10 days, those prices are going to drop because they need to fill those planes.
Counterpoint: JetBlue was up 15% today because of the guidance that they delivered.
Counterpoint. It was a $4 stock. Having
All right. Well, guess what? Delta.
I mean, look,
Delta, but Delta ripped too. The airlines all ripped.
Counterpoint wasn't there?
You can't triple
Did
stamp.
Alaska buy
You can't-
Hawaii?
you
I mean,
can't-
Hawaiian Airlines?
You can't
Come on,
triple
man.
stamp a double stamp. Hey, let me ask you this. I've been asking a lot of our guests.
wait. Alaska Air bought Hawaiian Airlines?
Yeah.
Can you imagine getting on a Hawaiian Airlines flight to Alaska? That's pretty funny.
That's sexy. That's
yeah.
what that is.
Brian,
Yeah.
if we get a softening of the labor market
Yep.
and a recession, which nobody wants to see, do you think that it's going to happen because of the interest rate increases, or do you think that we can say that's behind us and it will come from something that we don't see coming?
It's probably going to come from something we don't see coming. And I'm not saying we're never going to have a recession, because that's stupidity, because we will at some point. But it'll happen when no one's looking for it. And maybe this is a 25 or 26 theme. It's not going to be next year.
That's such a good point. 2022 was the year that everybody saw the recession coming, and the behavior that corporations made, in part, helped to maybe avoid a recession. Is that possible?
Yes, it is. And I will tell you that
We all braced for impact, and there was no impact.
if you go back to 2018, right, great market until Trumpy started fighting with Powell, right?
And China.
And China, give him the finger. And then Powell raised rates one more time in December. Market got hit. All the bears, and you know who they are, taking a victory lap, pulling their muscles, patting themselves on the back. And then January, Powell pivoted. 2019 was 1995 all over again.
He did 3 cuts in 19 after a month prior, saying we're nowhere near normal.
Right. And the market ripped, remember?
Yeah.
And coming into 2020, I'm like, we're going to have a recession. I could feel it. We're going to have a recession in 2020.
Well, you had an inverted yield curve in the summer of 19. And, we don't talk about it now because it did predict a recession and predict COVID.
2019 never happened for me. I have no memory of 2019.
No.
The pandemic sucked out all of my mental energy.
Yeah,
Honestly,
I totally agree with
I
that.
have no memory of 2019.
It was it was a great year for stocks. Stocks were up 30%.
Yep.
But you had an inverted yield curve for half the year. We don't even talk about that anymore. Because that omen came true, but in the form of COVID. Had we not had COVID, were we destined to have a recession in 2020? I don't know. We'll never know.
Might have.
Of course. Let's get to Belski's stuff.
All right, so Brian, I'm so glad that you're here because you put out your 2024 report and you've got some great charts that we're going to walk through. So 2024, it's the second year of a bull market. And John, let's throw these charts on, please. What are we looking at here?
Average performance of the second year of a bull market is 11% going back to 1946.
Not calendar, but like the next 12 months after the first 12 months.
So on average, a bull market, the first year of a bull market, and obviously I'm guessing that a bull market starts after a bear market. These are all post-bear market
so
lows.
if you remember, when we were here in February, we said the start of the new bull market started in October.
You son of a bitch.
Thank you. But nobody believed us. And then all of a sudden in June, we're in a bull market.
I thought we would revisit that October low back in February.
Most people did.
And in March, it looked likely with the bank shit. But
the way that they rotated out of those banks, man, and went into tech. And then you had the 3 tech rallies, right? You had the January effect tech rally, which you talked about in February, and then the rotation, and then the AI is coming.
The NVIDIA earnings call in May, that was the end of my bearishness. Like, that was like, oh shit, there's something else going on that's way bigger than Silicon Valley Bank.
Sometimes you get really lucky. And we bought NVIDIA 5 or 6 years ago because of the gamers. Yeah. And then EV. And then AI.
And then you forgot to sell it, and then AI. Right.
Oh, man, listen. Talk about 2022 and humbling.
Yeah.
If I had one NVIDIA email I had to reply to, or one on Shopify, we held them the entire time.
Dude, that stock fell 70%.
I know.
I was getting shit on TV like ask Josh, how's NVIDIA doing when it was 120?
So AI saved the market and it saved Josh Brown.
It really did bail me out. Thank God. Thank God for AI.
God.
I think though May was really the turning point sentiment wise, because it's when people revisited big cap tech again.
They started to believe in it again because the amount of conversations that I was having in the first 3 months of the year about, it's just January effect, it's you need to go back into these stocks. Nobody believed it, and then it was the March rotation. Well, where else are you gonna go? I can't own these fucking banks. Man. This is in trouble.
What else are you gonna buy? Oil's not working.
Yeah.
Right.
And energy. Remember how people were so bulled up on energy, and I think I said to you guys in February.
Oh, you couldn't buy dividend. No. Rates were crushing dividends.
Yep.
Yeah.
So then where else are you going to go? I got to perform because I'm performing. And then all of a sudden, boom.
Right back to Microsoft.
Yep. And then everybody, then here comes AI and everyone's a believer. But it's not just, I think what people are missing is it's not just NVIDIA. I mean, it is an amazing company, but there's other parts of AI and other companies in tech that I think that could really play in this from a longer term secular vision.
So
I want to get into the big moves thing.
Yeah.
Can we do that? All right. This is one of your charts. Big moves are less common in second year of bull markets. So let's assume we're in year 2. If the bull market started October, are we really in year 2? Are we started October 2022? Yeah.
2024, but year 2, yeah.
Yeah, we're in year 2.
Yeah, we're in year 2. Okay.
So the way that we said it was.
What's the average? What's the average, and then what's the second year of bull market?
Second year, the average.
Or year 1. This
Those
is the
are
S&P
outperforming.
500 percentage of days with daily price change of plus or minus 1% or greater.
Yeah.
In year 1, it's 26% of the time or 26% of days. And in year 2, it's more like 15. Am I explaining that right?
Yeah,
Okay.
That's exactly right. So what we said is this. Year 2023 was year 1 of the bull market, part of our 25-year secular bull market call that we've been out with, because you can have flat years and negative years in a big secular bull. Year 2, year 1 is the welcoming back. Nobody believes it. You have the type of moves that we had, climbing the wall of worry, January, all the stuff that happened. Year 2 is we kind of get back into normalized trading. What I said last year as well, as I said, welcome to normal. The title of my report this year is Normal for Longer.
Love it.
A play on words for higher for longer, because I'm so bored of hearing higher for longer. How about normal for longer? What's normal? High single digits to low double digit performance and earnings growth together. PEs between
mid-teens VIX.
PEs 15, 14 to 18, 19 on the top.
Check.
Some sort of a trading range. Now, I'm not a fixed income guy, nor do I play one on TV, not an economist, whatever. I think we're going to have some sort of a range-bound 10-year treasury hovering around 4% the first half of the year, 3.5% the second half of the year.
That makes sense to me, because what would be the source of volatility in the 10-year this year? I understand what it was this past year. This coming year, what would introduce like an out of nowhere 6% CPI print? Like, I'm trying to think what would make the 10-year be as wild as it just was.
Yeah, people ask me what I'm worried about. If you have some sort of a surprise to the upside on inflation.
Yeah.
But the other thing, you go back to of thinking contrarian, the death of 60-40.
Well,
I mean, come on, man.
we do a blog post or a YouTube show like once a week debunking that. So,
that was an easy call.
Yeah.
That was an easy call. And you saw how
Yo, imagine saying that shit a year after the Barclays Ag falls 13% and the S&P falls 20%. Imagine coming out then and saying no more 60-40.
Oh my gosh.
Like, of all the timing, this is literally the worst thing you could possibly say prospectively.
And I think a lot of people, they give us a lot of guff for saying we're in a 25-year secular bull market, but people forget that we had a 40-year bull market in bonds. And the last 2 years, we had negative real rates of return. We haven't seen that. And so you have a lot of people coming back in. Remember, too, that you had wealth advisors putting people in 5, 5.25, 5.5 money market accounts, or in big firms would have the balance sheet 6, 7% money market accounts. There's people sitting in cash still on the wealth side, and they have to put it to work. Dividend growth has been crushed this year, and value is starting to come back a little bit with financials, but I believe that there's going to be money put to work both in stocks and bonds. Every year, I try to sneak something into the report. And this year, I love pop culture. If you haven't noticed, and have you ever seen the movie Semi Pro?
Will Ferrell.
Yeah.
Jackie Moon?
Basketball.
Everybody love everybody. Honestly, when I talk about sector, size, and style, the title.
What was the name of the team? He's at Detroit.
No, the Flint Tropics. Flint Tropics.
They're based in Flint, Michigan, and they got palm tree.
Yeah. Yeah. Everybody love everybody. Right. The top of the page for sector, size, and style. Everybody love everybody.
Brian, what are the other normal things that you have normal for longer going to year 2 is maybe the equal weight catching up a little bit.
Yep.
So on average, in year 1 of a bull market, you see broad participation. You've got, on average, 280 stocks outperform the S&P 500. This year has been an outlier. Only 155 stocks have outperformed the index. You see that normalizing in year 2?
I do.
A catch-up trade?
I do. Part of it is actually what we're seeing fundamentally. Let's just talk about, the Magnificent Seven, which, by the way, only 3 of them are tech stocks, right?
Yeah.
Technically.
Because Amazon's consumer discretionary, so is Tesla.
And
Google's communications.
Google Machine and
Meta too.
Yeah. Are both communication services.
They are. They
tech.
are though.
No, but let's just come on.
They're tech. The S&P committee notwithstanding.
If Google's not tech, I don't know what tech is.
Yeah.
Well.
Anyway.
We're starting to see differing earnings trends and valuation trends there as well. So what's that tell you? If you're starting to see dispersion increase, it's not, I don't think you have to own all the 7. And I think that's going to carry through in the other areas. If you look at just charts with respect to growth versus value, not only performance, but valuation and earnings growth. And oh my gosh, the small mid-cap stocks, they look amazing. Not just because they're oversold.
They had a big week.
They had a huge week. They had a huge month.
What about them looks amazing? You mean relative to
12 times earnings?
If you look at S&P mid, S&P small, and SPX, and we have a chart in the report that shows price to free cash flow and return on equity, it looks amazing. In my 34 years, I've never seen free cash flow like it is in the mid cap stocks.
Yeah. What's in the mid caps? I know there's consumer discretionary there. There's healthcare. Well, does anything dominate the mid caps or not necessarily?
It's financials, some tech, healthcare. There's hardly in small mid cap land. There's not a lot of consumer staples.
Right.
So that's the one thing that you can just not own anything.
You're not going to get any tech in small cap, really.
No, there's some REITs. There's some decent REITs, especially in small cap.
John, let's keep it moving with the charts because there's a lot of good stuff. I want to make sure that we get to it. Brian, we're looking at you're saying that the largest S&P 500 stocks, and we're looking at the top 10, trade at a substantial premium to the rest of the market. So you're saying right now it's 25 times. This is next 12 months?
Yep.
It's 25 times forward earnings. On
the average is
19.
Yep.
And then if you exclude, so you're talking about if you were to exclude this probably looks sort of similar to the mid caps. You've got 15 times forward earnings. On average, it's 16. So just slightly less. So again, top 10 expensive based on forward earnings relative to average, and the rest not so expensive.
Yep, exactly. So that also bodes well for the value trade, the broadening out trade, as people. Who's to say we're not going to get some profit taking in some of these tech stocks that people don't want to be in? Our belief is, again, not all 7. You don't have to own all 7, but you should have representation in some of them. But I think given the fact that everybody says this, talks about stock pickers market, but I think we've entered into the golden age of stock picking again.
Say more. This is what everyone wants to hear.
Yeah, please. The golden age of stock picking.
I mean, this year is like adding insult to injury for stock pickers. It's like, wait a minute. If I'm not at least equal weight and I better be overweight,
you're short.
These 7 stocks, I didn't earn my salary this year. It's so bad right now for people.
Well, that's why November happened, right? Because they
November, no sell November.
Yeah, people had to be positioned.
Yeah.
And then that's why I think we could tread water and just, I don't like making short-term calls. But remember, portfolio managers and all the marketing people have to write their stuff for the next year. They have to have sponsorship in this, especially if they've underperformed. They have to show that they've been buying it to perform along with that.
Brian, if you're not short, you're long. I mean, if you're not long, you're short is the new if you're not first, you're last.
I don't hate that.
John,
Another Will Ferrell for all you.
If you're not first, you're last.
Yeah, ain't first, you're
I
last.
actually believe that.
all right, so relative price change
Yep.
of the largest 10 stocks versus the remaining stocks. I mean, this is obviously the story of the year. The Mag 7, the top 10 versus the rest of the market. They outperform. I mean, this is hilarious. Now, I've been making the point ad nauseum that you can't look at 23 without looking at 22. So you have record outperformance of the top 10. Not quite record underperformance, but last year obviously sucked ass for these companies. But the next chart that I really want to focus on is you say the S&P 500 can perform when large stock leadership fades. People are thinking that if Apple, Microsoft don't carry the baton, that the S&P can't work, and that's just not true.
No, and you have to also look back on those periods and what was going on. 92, we were coming out of recession. 98, we're coming. That was the Nifty 50, where Greenspan talked about irrational exuberance. Had nothing to do with tech stocks. Had everything to do with General Electric and Procter and Gamble and Coke trading at 40 times. In 2009, that makes sense because people sought liquidity. Why did they seek liquidity? Oh, because we were scared shitless, and that was the get back into stocks thing at the 666 lows of the S&P. 2013, that makes sense too. We talked about earlier that 2012, everybody was bearish, and so that was a bit of a ramp up. We had I thought 2019 was a great year because we had broader participation across.
Yeah. So
across
what
the
is
board.
this saying? That the top 10 stocks only did 2.2% better than the S&P in 2019?
Yeah.
Oh, okay.
Yeah.
So that was like one of those years that everyone's like, this is what the stock market should look like.
Right.
Did people like the market that year? I don't remember.
No.
No.
Of course
Nobody
not.
was happy.
You know, we spend so much time, rightfully so, talking about these big stocks. I'd be worried if RSP, the equal weight, if RSP was down 6 and the S&P 500 was up 20 because it was only the names, I'd be worried. However, the equal weight S&P is up like 8%.
Yeah.
It's not like the market is falling apart and the only things that keep it up is Apple and Microsoft. That's just not the case.
No, it's not the case. And I think that's why November, even though it was a period, let's go chase performance, we started to see the semblance of this broadening out already, not just from small cap, but also into value, and dividend growth actually did quite well.
So you don't think we're cutting next year? Do you think that the rate hikes are over? Because if the rate hikes are done, that would bode well potentially for value, at least historically.
Yes.
John,
That is
next chart,
correct.
please.
That
So
is
speak to
correct.
this. What are we looking at?
So
What's the headline here?
Value tends to outperform following end of rate hikes.
the end of rate. So if you go 12,
assume we're not getting one in December.
yeah, so let's go 12 months out. The average performance of the Russell 1000 value annualizes 20.6% following the end of the rate cycle 12 months out.
Versus 15 for
Growth.
That's a big difference.
Do you think
annualized?
Do you
Yeah.
think I'm going to hold your feet to the fire? You think that this happens this time around as well? You think value will outperform growth next 12 months?
Hold on. But other than 3 months out,
It takes time.
Every time period though, 6 months, 9 months,
60%
12
of the
months.
time.
Yeah, because remember, when growth is scarce, growth outperforms. So they hold on to that as long as they can.
Yeah,
right.
that makes sense.
That's a big part of it.
Those are the last stocks that get sold.
I'm going to talk my book. Everybody love everybody. I think it's going to be closer than you think. I think at the end of the day, if we're back here in December, I think value will slightly outperform growth, but I don't think it's going to be a massive outperformance, but it will outperform.
I'm totally with you. So if we don't, predictions are fun, whatever.
Yeah.
If I had to guess, I think that we're too early in the AI trade for growth to not work next year. I think value is going to potentially do better, but I don't think there's going to be a huge spike where growth underperforms dramatically.
No, and I think that there's a way to look at growth at a reasonable price inside value because you don't want to buy a value trap. When you're running value money like we do, there's always some sort of a contrarian play you want to play inside your value portfolio. So, obviously the contrarian play heading into next year's financials.
I think it's real estate.
Financials look good.
REITs too. I added. You know what? We bought Boston Properties.
I think mortgages have been crashing.
The XP looks good.
Now. I think like REITs are gonna have a moment. I don't know if it's next year, but
I think they're gonna have a moment. We also upgraded utilities. Anybody that knows me knows I hate utilities.
I own utilities.
Same trade.
Can hate them.
I bought the bottom, not to brag. Hand up. I did it.
Well, we telegraphed that because we did a report. We did a report late in
You guys
October.
are fist bumping over utilities.
This is exciting. But I was on with you and we were talking about NextEra, right?
Yeah.
And they were
Piece of
giving you
shit.
shit about it.
I hope it goes to zero now. I sold it.
But anytime you have this huge disparity in terms of performance of the highest yielding stocks, which is utilities are a big component of that, is like 1.25 standard deviations below what they normally sell off. That was the entry point.
So that's exactly why I bought it. Bespoke did an analysis like that, showing that when the S&P outperforms the XLU to that extent, like 25% over the previous
There's always
12 months,
a snapback.
that's the buy signal.
Let's do this margins chart.
Wait, hold on. Lastly, I don't want to get off sectors real quick.
Yeah.
Financials look good. Like they're trading well.
Oh, yeah.
I'm not talking about fundamentals. I'm just talking about the charts.
Always a head fake. They never follow through.
They're trading well. What if
Captain
What
Negative.
if 2024 financials lead? Nobody's positioned for that.
They're just so
Nobody.
They're just so cyclical. They never follow through.
You know, in the old days, it was as financials go, so go the market. Obviously,
No.
as tech goes, so goes the market now.
You think
We
they could
get
lead
that.
next year? You don't think so?
No.
We're overweight. But if you take a look at where
What do you like? What do you like in finance? I own some. What do you like in? I'm in
So I'll tell you-
Berkshire, J.P. Morgan.
Okay, so we made a bunch of stock changes last week, and
Okay.
I told the channel that because I was on Monday, the day that got printed, and I said you might want to have me back on Friday because we're making a bunch of changes.
Okay.
And one of the big changes we did is we blew out J.P. Morgan everywhere except for dividend growth. And the
It's
reason
the most expensive bank.
most expensive, number one. Number two, we already own Berkshire and Bank of America.
Yeah.
And if you're stock picking, you want to diversify out. We bought a basket of regionals because I don't know what's going to happen there, but I think they're way under owned. And
Well,
maybe,
if the hiking cycle is done, they should outperform.
and I bought specific ones in regionals or in regions where I thought the economy was going to be strong, like the Southeast, like Regions Financial. I mean, I think that's a layup.
You know, hit a 52-week high this week. Not 52, excuse me, all-time high. And this is not technically a financial. In fact, it's not really a financial, but Visa.
I kept my Visa. I sold Ameriprise in my value portfolio and wanted to fund it more. I bought more Citigroup. Everybody hates Citigroup. Everybody hates it.
What are you trying to get fired?
Everybody hates it. I'm telling you.
Well, what's to like about it?
Management change. They're cutting costs. They're firing people. It's great.
Chart's looking a little better.
Yeah. Cheap.
What are we saying about margins here?
Brian, what are we saying?
Margins have not collapsed despite macro pressure. This is the bear case: is that profit margins are peaking. Except the problem is it's been the bear case for 12 years.
Yeah. And if you go back, if you go back to 11 and 12, that was the call. 11 and 12 margins suck.
They're going to mean revert.
Right, mean revert. And we think that revenue growth is going to be good. It's just like coming into last year, into 2023, earnings, I think, are going to surprise. They're going to surprise.
People, all right, this is weird to me. Everybody would accept this statement. If I make this statement, if I say making a film in 2023, like you can make a higher quality film on every front than you could have made in 1983. Like visual effects, sound, editing, cinematography, music, acting. Like you can basically, not that every movie now is better than every movie from then, but I'm saying like technically, everyone would accept that premise. Why don't we, and we would say the same thing about like air travel. We would say the same thing, like things improve. Why don't we believe that margins could remain high because corporations have gotten better than what we're comparing them to? Like all of the people running companies now have the benefit of being able to look back at all the mistakes that previous corporations have made. So it's not that corporations are infallible, but it would make sense to me that if a corporation's purpose is to maximize profit, they're probably better at it these days than they were 50 years ago. Is that controversial?
No, it's common sense, but also it is.
But everyone says mean reversion. Like we have to go back to the profit margins of decades ago.
Yep. We have to because we
But
always
why,
do.
though?
No, it made sense. The argument, I think, made sense that the margins of some of these companies were so high that competition would come in and drive the margins down. However, what the Bears could not possibly see in 2012 was that Google and Microsoft and Meta were going to have 70% gross margins and monopoly characteristics. They couldn't have predicted that. So I don't blame them for getting it wrong.
Talk about efficiencies and productivity. I think AI to the next 10 years to disinflation, what offshoring was to disinflation the previous 20 years. I don't think we understand that quite yet. I think that we have been
It's an argument for margin preservation.
correct. It also is, if you going back to what I said before, we're so afraid to be wrong. We don't want to be right. It's been a secular change in terms of under promise and over deliver on Wall Street, and I think the COVID, and not being able to sit down with company managements across the table. You're on the stupid screen. You can't. The art of being able to talk to clients and talk to company management, not know when they're lying, that's a really big deal. And so all we do now as analysts are we're lemmings. Okay, yeah, whatever you say.
Congrats on the
Okay.
quarter,
Hey,
gentlemen.
great,
Thanks
great
for taking
job.
the question.
Great job. Caller
Appreciate
number 3.
you taking the question.
Yeah.
Brian, what happens if in 2024, and I'm not asking you the likelihood, but what happens to the market if we get multiple expansion and earnings growth?
Then we hit my bull case of 5,500, brother.
How many?
At
What,
260.
what percentage is 5,500 from here?
A lot?
No, is it?
1,000 points.
was
Are
like
we
tw-
45?
Is it
Am I-
25%?
Yeah, I'll take that.
I think everyone would. I think everyone would sign up for that.
So let's
Then
talk.
we get nervous about brother though. Then we start getting nervous about 2025.
Well, of course.
course.
I will be
I mean, what
very
else are
nervous.
we here for?
I will be very. If we go up 25, I will get very nervous. You spoke earlier in the show about this fallacy that higher interest rates means worse stock market performance. We grabbed this chart that shows what happens when the U.S. Treasury yield is above its 3-year moving average, which
Yep.
is what happened now. But that's not always so bad. Talk on it.
It isn't. So that's why we boxed that. And we said, if above the 3-year average and rising, okay?
Which
So-
sounds scary.
Hold on.
Sounds bad.
If the rolling 1 year price, if the 10-year yield is above 3%,
No,
What
above
are we
its
saying?
3-year average. So let's take
Okay.
the last 3 years. What's the average 10-year Treasury?
I don't even know.
And then is it falling or
Or rising.
rising or
Okay.
whatever? So chances are it's been falling, right? I don't know, right?
The average has been falling.
Yeah, the average has been falling because they peaked in October.
Yeah.
So the average has been falling. That actually portends to strong performance. But again, we were not normal.
You're saying in that period,
Yeah.
on a rolling 1 year basis, the stock market on average has been up 10.5%.
But what's interesting, it doesn't matter if it's rising or falling. If it's above the 3-year average, meaning interest rates
Stocks
are
are positive.
higher
Right.
than they have been for the last 3 years on average, that's not bad for the stock market.
Because here's why. The majority of time that interest rates are higher is because earnings are strong and the economy is strong. That's why interest rates go up traditionally. Because remember, we've been in a disinflationary
Right.
environment since 1982. Okay, and so again, we've reared an entire generation of investors that all they understand is that stocks go up if interest rates go down.
Yeah, the Fed has to cut for the market to go up.
Right.
Because, listen, they haven't read the history. They don't know about the 1950s when we're hiking rates basically every year to offset World War II era inflation. They don't know about that. They don't know that rates went up in the 80s and 90s, accompanying the second greatest bull market ever. They just don't, they're not aware because most people are not aware of what they didn't experience. So if you came into the market in 2010, 13 years, all you know is that every 5 years, somebody screws something up and the Fed has to cut rates to bail out the stock market.
Correct.
So I get it. Like, I understand it.
So that's why this
I would think that too. I just happen to have had a little bit of history predating that where it wasn't that way. We weren't rooting for Fed rate cuts in 2003, 2004, 2005. That was not, the bull case was not, holy shit, this is great. The news is getting worse. Therefore, the Fed's going to come in and cut rates. Nobody wanted that.
That's what that's why it's just crazy that we're looking at macro. We're looking at Fed funds futures that have been wrong, by the way, wrong. Everyone's focused on that.
Yeah.
And they're not making decisions,
Yeah.
right?
Yeah. I totally agree. What's this presidential election stuff? Do you believe in this stuff? You like the election year cycle? Where it worked this year. We're in the third year of the presidential cycle. It's supposed to be a great year for stock market. Well, guess what? It really was.
Yeah.
Coincident? I don't know. Causal?
The stock market does great after midterm elections, historically.
All right, so we got
Historically
it. So we
does.
got that.
That's number one. Number two,
It worked.
Look at this background. Great job, John.
America.
There we go.
Yeah, that's good.
John is
So
just crushing
Democrats
it.
seeking re-election.
That was Daniel. Well-
Market's
well done.
usually up.
Daniel,
okay?
well done.
Market's usually up. So I remember.
Is the president really seeking re-election, or are the people that handle him like just kind of telling him, yeah, we're going to keep doing this? Like, I don't know. Is he like seeking it? Does he really want to be reelected? He's not acting like it.
He doesn't know.
He doesn't know. He can't know. All
Listen,
right. Somebody involved is seeking reelection on his behalf.
Take it easy on the old man.
Listen, I've said this publicly, and I'm not showing my cards, but we have to be, honestly, let's just be some common sense here. We have to be the laughing stock of the world, right? 2 octogenarians running for president. One's an egotistical narcissist, and the other one has to be jacked up on Adderall, cocaine, and Red Bull just to talk. I mean, no disrespect.
Yeah. No,
come on.
And it came through that way.
And I've said this in print. So politics have nothing to do with the absolute performance of the stock market.
Yeah.
And I wrote that specifically in my year ahead for 2021 because everyone's freaked out. The blue wave is coming. The Democrats are going to come in and they're going to tax everybody and the growth is going to... Guess what? 0 interest rates takes care of all that, brothers and sisters.
Yeah.
That's why the market went up in 2021, not because of anything politically.
Politics is not quite the number 1 or even number 2
Nobody's
reason.
calling that the Biden bull market.
No,
2021.
No.
It's not the number 1 or 2 reason why people lose money, but it's up there. People make very bad decisions based on politics.
Let's jump to S&P 500 2024 year-end forecasts. So you're on here. This is
hey.
my friend Sam Rowe shared this. Sam does a lot of really great stuff at the end of every year, collecting everyone's outlook for the next year and then putting them into context of how hard it is to get the stuff right. But you and Deutsche Bank are at 5,100.
Yeah, I saw Benke down in Baltimore.
Do you know that guy?
Sure.
I don't know. I never met him. Is he good?
He's a really nice guy.
Okay, you should have won 5,101.
Yeah,
you want to be Belski the bull. You got to earn it. All right. RBC's at 5,000. Bank of America's at 5,000. I read. I don't know who comes up with the target, but I read Savita today.
Do we know what the average is?
Goldman 4,700. Looks like the average is 4,200 of these. Morgan Stanley 4,500. JP Morgan 4,200, which is interesting. Do you read other strategists' rationale behind their calls or is that too distracting for you and you don't want that in your head?
Because
you've been in this seat for years. Like, what is that like
than all
for you?
these people. I don't know if that's good or bad.
Wait, you what?
I've been in the seat longer than these people. All of these people.
Yeah.
I don't know if that's good or bad or indifferent.
I think it's great.
Unless
you don't want to be in it, in which case it's not good.
No. Well,
you seem pretty happy.
Listen, I love my job.
Okay, good.
It's a really, really tough job. And all of these people are great people and they have different processes. And I know all of these people and how they got there and their background and everything. Yeah. And I would never disparage them. But let's just call it what it is.
Do it. No, we're just kidding. We don't disparage anyone.
No, let's not disparage. But you got to think about who the clientele is that they're going out there with this, right? So who are the primary payers of commissions on Wall Street?
Hedge funds.
And are hedge funds bullish or bearish?
Usually bearish. I mean,
enough said. Drop the mic. That's like a drop the mic thing.
Isn't historically, don't strategists always get tarred with the term like, oh, they're always bullish? Now it's weird. Like last year, they were super bearish and wrong. Now they're not so bullish, but they're not so bearish. But I thought everyone makes fun of big investment banks on Wall Street because they're always rosy. Now they don't seem that way.
No, I mean I think there's been a secular change. I mean, you go back to the 90s.
Yeah, everyone was a bull, but they should have been.
Right,
we're going up.
But a lot of the strategists were late to roll over, and then analysts were the bad guys, and then everybody started modeling their own, and they looking at macro and looking at quant, and kind of said no to the strategists and no to the analysts. So I think we're going back to old time hockey. You have to pass the puck, you skate with the puck, you shoot the puck. I'm just a simple Minnesota kid, and I just think we're going back into storytelling. I really pushed my team when we had the bank issue in March, saying, I want to look at every bank we own. I want to look at how long the CEO and CFO has been there. I want to see what's on their loan portfolio, what's their track record in terms of earnings, what's their balance sheet look like.
Well, you were looking for sell candidates.
Yeah, are we wrong? Because the hedge funds are going after really great companies. And they came back to me, they said, because my team's like, we got to sell these. And I'm like, do the practice.
On the surface.
Yeah. So let's follow the practice. Everything I said is good old-fashioned, roll up your sleeves and do stock picking and do the analysis. And I'm here to tell you that a lot of people don't do that anymore. And we kept all of our banks, and those banks have tripled.
JP Morgan is the most bearish, at least on Sam's list of 12 companies or 12 analysts that did this. They're at 4,200, and they're at $225 a share for the S&P 500. Here's a quote that Sam pulled: with the step down in economic growth next year, U.S. growth to slow to 0.7% year over year, eroding household excess savings and liquidity, and tightening credit. We see 2024 consensus hockey stick EPS growth of 11% as unrealistic. Negative corporate sentiment should be a catalyst for sharply lower estimates early next year. I'm guessing you don't agree.
Macro.
Oh, really? There's nothing bottom up in there.
No bottom up in there. Oh, by the way, go talk to a company.
Yeah.
Like I have the really good fortune of going around and talking to some of our commercial bank clients at BMO. They're bullish, right? They're believing. Okay, we're America.
Like what? CFOs or CEOs? Who's bullish?
Connect both.
Both.
Yeah.
Okay.
And
It's so weird. The macro is always bearish, but the macro is bearish and the bottoms up is bullish.
correct.
Can I tell you something? I was looking at this McDonald's thing today.
Tell me.
Speaking of bottoms up all right, McDonald's they had a character in the late 80s, early 90s, Cosmic. It was an alien that would land and like eat all your French fries or whatever. It's one of their McDonald's land. So McDonald's had a slam dunk this year. They did the Grimace value meal or something. And I'm not going to deny that I had one. Anyway, they are launching this new concept, only 10 stores in Texas at first, called Cosmics. And basically they want to take on Starbucks and Dunkin' for that fourth day part. It's not breakfast, not lunch, not dinner. It's like that 3 o'clock. I need some caffeine and a snack. I need like a slushie and like a something.
What are they serving?
So it's they're gonna have 10 of these, so that's not really gonna move the needle. But just the point that there are companies will always find a new. Can you imagine they capture a meaningful part of that day part? Probably it hurts Duncan more than anyone else, right? What do they serve? I don't know, shit that you probably shouldn't eat. But it's like it's an example, I think, of a giant company that's done so well, stock price near an all-time high, but they're never satisfied. They're never not looking for the next way to grow. And I did see the menu. What do you think they would be selling here?
Yogurts? What's
Like
a midday snack?
like slushies, like
What do you mean slush?
like
Slushies at McDonald's?
Like icy. No, it's not a McDonald's.
Oh.
It's another concept. It's another store.
Yeah, but it's a derivative of
It's a smaller footprint.
okay, there we go.
Thank you for that. It's a smaller footprint store, and it's like snacks and drinks. It's not Happy Meals. It's not burgers.
Okay.
It's like an egg white wrap on a piece of bread, or like they have like little pastries. But I'm just making the point.
Yep.
This is how Fortune 500 companies are thinking about next year. We're not retrenching. No. We're coming up with new things to do that will grow businesses.
Slushies is the answer.
Slushies, obviously.
Caffeine, slushies.
Let's
Super Bowl
Let's
up on
talk
this.
about something that happened inside of the market last week that I thought was a really good flag from Grant Hawkridge at All Star Charts. All right, he looked at the S&P 500 returns when there's a 20-day breadth thrust. And what we're looking at here is the percentage of S&P 500 stocks at a 20-day high. And that spiked. Historically, that is super duper bullish. If you go out, I'm going to pick 1 year, but we'll share the charts. If you want to see this, you could go onto our sites. The percentage of times over, when did this start? Since 1979 that this is positive, it's 96% of the time a year later. And guess what? There's not like 3 examples of this. There's like I just eyeballing this like 25 times.
30 examples.
Wow.
So people get, JC always makes a point. How could an overwhelming demand for stocks be a bad thing?
Well,
People are afraid to make
they
money.
assume it's a bubble when a lot of stocks go up all at once. That's like the assumption is like it's euphoria. So
Yeah, but that's a fallacy though, because you
no,
can't.
we know.
But euphoria, first of all, it's not euphoria. But I would, using that word, euphoria is bullish. Euphoria is not bullish. Heavy demand for stocks. When you see something like that, that is bullish. Just look at the numbers. It is.
It is, but you know the whole term of bubble and greed and all that kind of stuff. You can't have that when you don't have the stocks can go up, and that's not just because things go up doesn't mean it's a bubble. It's a bubble when we get frothy and greedy and lazy.
No. That's not the definition. The definition of bubble is when stocks go up and you don't own them. That's when it's a. That's
One
when
thing
it's
that
a
I would
bubble.
say to that chart, you get those bread thrusts when there is an overwhelming amount of pessimism. That's when it happens, and that's bullish.
Correct. And you're not going to have this massive bubble in tech until we have massive IPOs and lots of buyouts.
We didn't get that this year.
Nowhere near that. You
I
need
think a lot of
financials and tech
people-
to play with that.
I'm so glad you said that. A lot of people, myself included, thought capital markets would come roaring back in the second half, and they really didn't. We got 3 tentpole IPOs, really big deals. ARM, the spinoff from J&J, Kenvue, and what was the third?
Insta.
Instacart.
And
then
Birkenstock.
they said, "F it, here's Birkenstock." No, all right, we're done for the year. That was it. You didn't hear about deals after
That's
that.
true. The IPO window's not open. I mean, it's opening up.
And
but-
remember too, there's this theme: you buy scarcity and sell capacity. Buy scarcity and sell capacity. And so that's why I think too, you're going to start to see investors go down in cap to mid and small for beta and also for growth because there's no IPOs.
Just one more thing on this topic. I just want to set the record straight that I'm not bullish on Euphoria. Euphoria is not bullish. But what this chart is, it's
Too late. We clipped it for social media.
It's the clearing out of pessimism. It's when you get excess pessimism and you get that bread thrust.
Yep.
You're killing the pessimism. That's bullish.
Yeah, I would agree.
Okay, you're on the record there.
Thank you.
Let's roll through some of these really quickly because it's not that much to say, but they are bullish. Net worth. Ed Yardeni says household net worth rose to a record high of $154.3 trillion during the third quarter, and that is up $37.6 trillion since Q4 2019, i.e., the last ever normal quarter of American life.
Capitalism is in a bubble. It's clear.
Look at this chart. Like what? This is bearish. Explain how.
I don't know. I don't get that.
Let me show you the second one though. This is the composition. This is U.S. households, selected assets, and net worth. They're all at record highs or very, very close. This is equity shares, this stock market. Owner's equity in households is the red line. Pension fund reserves, deposits in money market funds, equity in non-corporate business, I guess private equity.
Yeah.
Debt securities, life insurance reserve. They're all higher than ever or trending in that direction.
The United States is very rich.
A lot of money.
All right. Let's do this one. T-bills. I wouldn't call it a bubble. I'm buying T-bills. I'm happy, not in replacement of stocks, but in replacement of cash.
Morningstar had a great post. This is Amy Arnott, T-bill and chill. She was talking about just people getting too comfortable, maybe a little bit too comfortable in cash. Eric Balchunas.
What's that number, Mike?
Hold on. Eric Balchunas grabbed a chart of money market funds.
Holy shit.
And Eric's
Not bearish.
Eric said,
No.
imagine this comes off the side. This is real cash.
Guess
from the
where that money's
sidelines.
going?
Yeah, exactly. Back
Is
into
that
the market.
$5.7 trillion?
Yes. So Eric said, listen to this. 14 money market funds have taken in over $20 billion each in 2022. I'm sorry, 2023. And the top 12 and 25 of the top 30 flow getting mutual funds are money market funds. Let me say that one more time. The top 12 flows into mutual funds are all money market funds.
crazy, dude.
And 25 of the top 30 flows from mutual funds are money market funds.
Are we going to look back at that and say that was one of the great contrarian signals of all time?
Yep.
You think so? Mm-hmm. Okay.
We had some of that in 08, too late in 08.
So you could say that.
What happened? Hold on. What happens the first Fed rate cut? How fast does the money come
I don't
rushing out
agree
of
with
money
that.
markets?
I don't agree with that.
I don't.
I think it extends duration or it goes into stocks. I don't think it sits there.
I think that cash moves very slowly. I think it was slow to go in and then it accelerated. I think it's going to be slow to come out. I do.
You don't think so?
No.
You think it's a tsunami out of money market?
Similar. We had a similar thing.
That chart's not going to crash.
No. But I remember in the fourth quarter of 2008, still at Merrill Lynch, and we'd go around to the offices, and I would talk to the managers, and they say this is the fastest buildup on a quarterly basis of money markets in Merrill Lynch history. And then the next quarter,
When was this?
fourth quarter of 2008. Then the next one,
I remember that.
and then the first quarter of 2009, it was the fastest move in bonds ever into bonds. And then after that, I was gone already, but I was still talking to people there. We had a massive flow. Merrill Lynch had a massive flow back into equities.
What, after it bottomed in March of 09?
Right.
When was it this summer?
So it would have been April, May, and June.
Yeah.
I think money is more likely, to the extent that there will be a tidal wave of buying in equities, it's come from bonds, not money market funds.
Come from bonds?
Yeah. I just think cash doesn't move that fast. Cash doesn't move from money markets into equities. That's my opinion. We'll see. But I think the decision to get 5% at the beginning of the year and miss out on a 20% gain in the S&P 500 was a rational decision.
Depends on what you're using the money for. It's rational for some people. For other people, it was stupid.
It was not stupid.
If you were using the money, it was smart because then you sat in cash, and at the end of the year or whenever you were going to use the money, you didn't have anything at risk.
If somebody was in a 60-40 portfolio and somebody said, you know what, I kind of want to take 10% of that and put it in just safe 5%. That's not a dumb decision.
No, I don't think so. But again, it's if you're 28 years old and you did that, why did you do that?
Yeah.
For to what end? Right.
Right.
4-day work week, thanks to ChatGPT and Copilot. Jamie Dimon thinks so. Ray Dalio thinks so. I would take the other side. I cannot imagine people not doing stuff, not trying to make more money by working more. I'm sure there'll be some subset of people that will, but for the most part, societally, I don't see it. But I could be wrong. People used to work 6 days a week, right?
Mm-hmm.
Okay. What do you think?
I know I used to work 7 days a week.
I work 7 days a week now. Are we going to standardize a 4-day work week because
no way.
large language models are going to do all our work for us?
No way.
I don't see it, right?
No way.
It's
Now, remember last time, the very first time I was on here,
Yeah.
talked about going back to work. Remember that? And my son said, have you seen the comments on YouTube about your dad? Nothing about the market calls. Like, they're giving me shit about go back to work.
Yeah. Right.
Anyway, yeah.
Jamie Dimon says future workers will be at their desks just 3.5 days a week. I mean, maybe at JP Morgan.
Maybe there. Yeah.
Apropos of really not much, just maybe productivity and AI. So Google was up 5.3% today. I wonder if this is this has got to be one of their bigger moves outside of an earnings day in a long time.
Definitely.
Right?
Yeah.
Up 5.3%.
Oh, no. They had a day equivalent to this on the way down when they did a live demo of bars.
That was a disaster.
And it made a mistake in front of an audience. The stock got killed that day, right?
Killed.
Are we looking at that?
It was early in the year. Yeah, right
So
here.
this
Killed.
is the reverse of that. They launched an AI on Sundar Pichai's social media
Bombed.
where it can it can accurately tell the difference between a chocolate chip cookie and an orange. I'm sold. Add $90 billion to Google's market cap. I totally get it. I mean, that's what's going on right now, whether you love it or not, right?
That's crazy.
All right, last thing. I think this is so cool. One of my favorite things about streaming music, Spotify and Apple, the digital streaming platforms, is that my kids are developing really good taste in music because they are being exposed to older music and not even realizing how old it is or anything, just saying, I like this. I drove my daughter to a dermatologist last night. She's like, Dad, I'm DJing. We were in 40 minutes of traffic. So I was like, all right, you're a DJ. She plugs her phone in. She does like, I don't know, 20 Jay-Z songs back to back. I'm like, how do you even know any of that? Like remixes that I've never even heard. It's all because of Spotify and Apple Music. And I think that phenomenon is a really cool thing. Kids might not buy albums anymore. Okay, so what? They are learning. And to that end, this week, the number one song on the charts is a Brenda Lee song, 65 years old, Rocking Around the Christmas Tree.
Wow.
Yeah. So I think most kids know it from Home Alone.
That's where I know it from.
Yeah. But whatever. The point is, that's the number one song on Billboard's Hot 100 list is a song from the 1960s.
Thank you, TikTok.
65 years ago? 59? I don't know. What year is that?
I think probably before the 60s.
Let me say.
1958.
Well, if it's 65 years ago,
It says 58.
1958. All right. I think that shit is cool. What do you think?
I think if you sent Brenda Lee, I said, crazy. That's what I think.
Do you remember the meme of the guy riding a skateboard, drinking like a ocean spray cranberry juice, just like vibing out to Stevie Nicks?
Yeah.
Fleetwood Mac Dreams.
Yep.
And then that song went to number one. Like that's what's possible with streaming music. That would not happen in a world where kids are buying albums. I think that's only possible now. I think it's kind of cool. Like I hope it continues. And maybe these kids know more than we think they do about taste. I don't know.
Well,
somewhat positive.
I think it's really good that they're actually liking music because,
Yeah.
like real music.
Yeah.
And I've said this for a long time that I'm obviously a huge Apple bull and I own it in a lot of portfolios, but we also own Spotify.
Yeah.
And I think from
What'd you think of that? What'd you think of that layoff memo this week? I thought he handled it really well.
I think so too. I think it was great.
Okay, it's a lot of layoffs though.
Yeah, but I mean, again, that's when you right size. That's a good thing. But on the Spotify side, I do like the way that Spotify streams its music better than Apple.
So do I. I use both, but I like.
And they have
Spotify.
some. And by the way, they have better versions of songs. And
I think it sounds better.
It
Why do I
does.
think that?
Is this like the Gary vinyl
no,
argument?
because
What
they
the
have
f-
a lot
are
of
you talking about?
remastered. They have a lot of remastered content.
Yeah.
More than Apple, and you can mix the songs together.
You guys
like
are
a DJ.
delusional. You
No,
think,
come
You
on.
think that
No,
Apple?
you know what? I'm gonna teach you something later. That I know I do this every week, and I lecture you like I'm 30 years older than you. I'm telling you right now, Zach Brown Band put out an album of all of their live covers. They do a cover of Baba O'Reilly, The Who. That is so ridiculously good. If you listen to it on Spotify versus if you listen to it on Apple Music, it doesn't sound the same, and I don't know why. I don't know if it's the Atmos or whatever that tech. I don't know, John.
There's no way.
Why does it sound different to me? Am I tricking myself?
Depending on the program and your settings, it can stream at a different bit rate.
It's my settings that make me think. Erase this whole section. I sound like an asshole. What's your favorite Christmas song? You're gonna make a holiday playlist. You could only have one at number one. Where are you going?
Let us know the Harry Connick version
Okay, why? That's the jam.
because it's just chugga chugga
All right.
chugga. Oh,
What do you got?
Cold outside.
What's the rapiest Christmas song of all? That's the one.
I like that song.
It's have you ever listened to
Yes, I was. Yeah.
it? I mean, it's bad. I think it's canceled. That song get
It
canceled.
did get canceled.
It did, right?
Did you see the comedic bit of a guy who said, "Here's the song that got canceled, and here's the number one song in America." A guy did this. I don't know what comedy club he was at. He read the lyrics to "Cold Outside." He read the lyrics to "My blank is blank."
Yeah.
You saw that?
Yeah. Christmas song. I think I have to go with Christmas and Hollis. Run DMC. Still a class. Still, you put that shit on right now, it still slaps. So that's
My favorite Christmas song is "Die Hard."
great. All right, let's do favorites. Do you have fun on the show today?
I did. Thank
Just
you.
occurred to me we didn't introduce you.
Oh, hey,
Brian Belski is. You don't need an introduction. Our audience absolutely loves you.
by
You
the way,
crush it every time
thank
you come.
you so much for having me. And I
course.
must apologize because I was supposed to be on in October, and the reason why I had to cancel was my Minnesota Twins were in the playoffs, and they swept the Blue Jays, and I was supposed to be here on Thursday.
Hey now.
And I could have been here, but it was too.
No, you made the right
Yeah.
choice. You made the right choice.
Well,
Thanks,
speaking of
man.
"Hey Now," rest in peace, Ralph Sorella. Holy shit!
Yeah, that's sad. Norman Lear this week too. We
Yeah.
lose. I mean, it's always every week.
I mean, Archie Bunker, right? I mean, come on.
yeah. I looked at the list of shows. Norman Lear. He basically raised us all.
Yeah.
If you think about it, like those are all the shows that you came home from school. My generation, we came home from school to watch those shows.
I
All of
remember. I remember watching them on Saturday night.
Saturday night. Well, when
Saturday
they're
night on
actually-
CBS, with live. I mean, Saturday night was the big night.
He was a genius. All right, let's do favorites. What do you got for us? You gave us Last of Us. I love that show. You
Yep.
ready for season 2?
Oh,
It's coming this year, dude.
No, it's coming out in 3 years. When's it coming out for real?
This year.
Is it?
Yeah.
first of all, it's the Mandalorian, right? So he's badass, and I watched the first.
Pedro, what's his last
Pascal.
name? Pascal.
yeah, he's gonna be
great.
Now he's gonna be in the Fantastic Four too.
Yeah, he's going to be
Reed
Reed
Richards.
Richards.
Yeah.
Oh, they
Perfect.
announced that? I missed that.
Yeah.
I love it.
Yeah,
I love it.
They're 0 for 3 on that, by the way. They have not made a good one, but I'm excited.
All right, so Last of Us has a killer soundtrack. We talked about that
Killer.
before. Yeah, I agree. A lot of my favorite TV shows also have awesome Spotify playlists accompanying them. The Bear is another
the
example.
Bears good.
How good is the music in The Bear?
Amazing.
Amazing. right?
Morning show,
Yes. Yes.
especially the first season. Really great music.
So
There's a show called A Murder at the End of the World. It's on Hulu. And I started watching the first episode, and the show opens with People Are Strange.
is that a show?
The
that's-
original version.
It might have been the Spotify version. I don't know.
Wait, who's in that?
Nobody famous, but it's on Hulu. And
Did it start already?
Yeah, it's getting some hype.
Okay. All right. Is that your favorite for the week?
No.
Okay, give it to us.
So John Collison, one of the founders of Stripe, interviewed Charlie Munger on the Invest Like the Best podcast feed. And it was an incredible interview. And I want to read one thing. This is part of their conversation about crypto. And John Collison, he's bullish on crypto. Obviously, Munger was not. What he said I thought was funny and very wise. And it's not even specific to crypto. So John Collison said, it's not really a new currency. It's a new store of wealth. Charlie said, you can call it a store of wealth. I call it a store of delusion. That part made me laugh. But here's the part that I thought was very wise. Not specific to crypto. He said, I don't think it's good to participate in a delusion, even when it gets quite common. And that lesson is a very, very, very hard one to learn. And it's one that you can only learn.
Unless it turns out it wasn't a delusion.
It's only a lesson that you learn like over decades of investing.
Yeah. I go back and forth on this because Berkshire, like they admit they missed Amazon. They should have bought it. And at the time, Amazon looked like a delusion. It was a company losing tons of money, telling Wall Street, we're probably not going to make money for a long time. And the stock price went up and up and up. And if you're an old school investor focused on cash flows, you probably look at that as a delusion.
Tesla looked like a
until
delusion.
It's not a delusion.
A lot of things do.
It's harder than a catchphrase.
It's not black or white. I just thought it was a great quote.
Yeah. Shout out to
and an amazing episode.
Shout out to Patrick O'Shaughnessy. All right, I have a bunch, but I'll do them quickly. The Time Person of the Year cover story on Taylor Swift is great. So the writer followed her around during the course of the Eras tour and checked in with her throughout the course of the year. It's really well done. It explains how, for the first time in a long time, the world had a main character. She was the main character this year.
When's the last time?
Probably something political like Trump.
Oh, I thought they named.
Yeah.
Okay.
It's usually something political. It's usually not a pop star. It's like very rare. And they reference like Michael Jackson and stuff. But like this year, she was the main character. It's not that she was the most important thing. She was the common language we all had. Hey, did you see that thing about how the concert sold out in town or whatever? She was an economic event everywhere she went. The tour obviously is record setting. Probably nobody will ever do what she just did, or at least not for a very long time. So I thought it was a good article worth reading. I also wanted to mention the Blog Era, which is a podcast series about a very specific era in hip hop. I know I don't have any rap fans in the room. So well done. It's The Real, and it's just a document basically. I think it's 10 episodes. They got all of the people, almost like an oral history, but it's this really specific era that really mirrors finance. So from 2007 till maybe 2013, blogs were the tastemakers in rap. They replaced the magazines. They replaced the radio stations. They decided who would be a star. If you think about who they broke, from Kanye to Kendrick Lamar to pretty much J. Cole, Drake, Nicki, all the biggest hip-hop stars now were broken by blogs. Like, that's how we discovered these people. And it was really well done. And I have a bunch of friends who were interviewed for it. So that's what made me listen to it at first. But I think people will be into it. Last one, Noah Khan. Noah Khan fan? No? Okay. It was on Saturday Night Live last week. He has one of the biggest albums of 2023. It came out in 2022, though. It's called Stick Season. You're a Northerner. You know what Stick Season is?
No.
Okay. So he's in Vermont.
Okay.
Stick Season is that period of time where after the foliage is gone, which is why everyone goes to Vermont.
Yeah.
But before everything's covered in white.
Yeah.
You got like a 2 or 3 week period where everything is brown and sticks.
Okay.
All right. Anyway, that's the record. He was on SNL last week. He's like selling out Radio City now. He's a huge up and coming star. Great album. It was nice to see this thing have legs and be popular for like 2 years now. And it seems like it's getting more popular. So I thought that was kind of a cool story. All right. That's all I have for this week. We want to thank John, Duncan, Nicole, Sean, Daniel. The list is getting long, right? Rob is here. You guys are awesome all week. Thank you so much. Our special guest, Brian Belski. Tell us where we could find you on X. You are Brian at Brian G. Belski.
That's right.
Okay. And you're
and on LinkedIn. That's it. That's the only social media. LinkedIn and X. That's
Brian G. Belski. Dude, you crushed it this year.
Oh my gosh, thank you.
Amazing prescience to see what a lot of people couldn't see. Almost everybody was bearish. You were bullish. And it looks like we're about to close right at your target. You're gonna walk on water on the way out of here. That's all I could say.
Float on here.
All
Thank
right.
you so much for having
Dude,
us.
thanks for sharing
Right,
your time
man.
and your
Thank you.
expertise with us. We appreciate it. All right, Compound and friends, we are out. Thanks for listening. See you soon.